Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Welcome to the LFI Levered Lines podcast. I'm Tom Davidson, a senior editor with LFI in New York. And I'm very pleased to be joined here today by Jim Schaeffer, who's Global Head of Leveraged Finance at Aegon Asset Management. Jim serves as a portfolio manager for the various leveraged finance strategies at Aegon, and he's also responsible for stressed and special sit securities and all restructuring and bankruptcy situations for the firm. It's great to have you here, Jim.
Thanks for having me. It's great to be here.
So, Jim, could you tell us a little bit about your background, please, to start?
Yeah, I started my career in corporate banking and investment banking. Made the decision in 1999 to go to business school with the idea of going into private equity, but went into business school in a great job market, left in a terrible one, and found myself in distressed debt right after. I had a very debt-focused experience in corporate investment banking. So started into distressed debt, working through a lot of the restructuring activity that occurred in 2001 and 2 and 3, and then joined Aegon in 2004 to run distressed debt. And that's where I spent the early part of my career at Aegon. And really, my view of it was I kind of took a different approach to thinking about restructuring activity, trying to have our distressed team more integrated in the research element and what was going on, and basically trying to get people out of our portfolio managers out of credits earlier in the process, basically doing analysis focused on if we're wrong, how wrong are we going to be, what's the downside, risk of bankruptcy, risk of default, that kind of stuff. And that worked out very well for us in 08 and 09. I had a lot of success going in and out of that, the great financial crisis. And that led me into kind of running all things leveraged finance. And so I took over running the U.S. leveraged finance platform in 2012 and did that kind of the rest of my career. And that's expanded to a global role. I had a few other roles in there, including deputy CIO, but generally I've been running leveraged finance since then, which is high yield levered loans and distress since 2012, first in the U.S., then globally.
Great, and it's very interesting for me to have a head of leveraged finance on here with a background in distressed debt and not performing credit. Do you think that colors how you manage your loan and high yield funds and your CLOs?
Well, it's an interesting question. I think at the root of it all, I'm probably a little more cynical. My background is always looking in ways for what could go wrong. When you're in distress, I think there's an element of creativity to what you do because everything's very idiosyncratic and unique in every situation, which is helpful because high yield and leverage loans, levered credit has a lot of elements of idiosyncrasy to it. But I think for me, just being cynical, kind of looking for the downside, realizing, hey, this is an asymmetrical asset class. For us, that's helpful to think about the downside, think about protecting our investors, and trying to make sure we're well positioned to be a all-weather manager, i.e., performing well through a cycle. So for me, probably the cynicism is the one main thing that stands out, and thinking more about the downside and understanding that, which is why I still get involved in a lot of the more stressed credits when I'm looking through our portfolios.
Great. Well, let's turn to the current market. Now, on the face of it, leverage loans are doing great this year. A few weeks back, we put out a story saying that the nominal average spread of the JP Morgan Leveraged Loan Index contracted to S plus 330, which is a 15-year low. But what's your take on the real situation below those averages?
Well, it's a very bifurcated market, as you highlight. I mean, spreads have been very firm. Technicals are very strong across high yield and leverage loans. And we've seen this, endless appetite of buying. There isn't a whole lot of net new money out there. There are a lot of warehouses out there, I think over 100 in the US. So there's this incredible technical demand. And you see that in all the repricings and what's going on in the market, and continued spread compression and probably frustration from CLO managers across the land. The reality of it is that, earnings are okay. They're probably a little bit better than people expected in 2Q. I think, positive earnings are a little better than negative earnings, and guidance was a little bit better. And I think the impact of tariffs feels a little better than maybe the market expected. So that's some positive out there. But as I said, there's a lot of bifurcation in the market. You've got probably 6 to 10% of the market that's more challenged. That's dealing with a lot of LME activity, restructuring activity, just trying to deal with the higher borrowing costs, the higher, nearer term maturities. And although you've had tremendous capital markets access over the last period of time, which we've certainly seen a lot of maturities get extended for what I'll call the haves, that 90% of the market that's doing quite well and it's trading really tight. The rest of it is where the challenge exists. And I think as portfolio managers, you have to really focus on that piece of the puzzle, because it can have such an impact on whether you're a CLO manager or a portfolio manager in a mutual fund or whatever, a really big impact on your portfolio. There's very tight dispersion in the market. So that's the underlying market. It is generally fundamentally okay, but there's a piece of it that's still challenged. And what's most unique about it is a lot of these initial LME transactions that went through 2 years ago that dealt with nearer term maturities or liquidity issues or the like are kind of recircling, coming back to us again, because maybe the market didn't really change. We still have higher borrowing costs. We're still dealing with inflationary pressure and challenges of passing along input costs. And all of this is out there, and the longer it goes, the more it weighs on companies. So I think we're all sort of expecting the market to slow. And that's really what the Fed was trying to do for a long time. And how far that goes and the impact it has on the market is what's most interesting going forward to me. But again, at the core of it is the earnings have been okay, good enough to keep the market where it is and to keep that, I'll call it exuberance, but strong technical backdrop existing out there.
Great. Well, you've already mentioned the acronym, which seems to be every loan and CLO PM's favorite subject this year. But I think we should delve a little more into LMEs, liability management exercises. So what's your experience of them this year? And do you think things are getting better or worse?
It's a great question. I mean, we've got a pretty robust distress franchise, led by Rishi Goyal. And we're kind of in the middle of a lot of them across a lot of sectors. I mean, we take a very active approach to how we think about distress and stress investing. So we want to be involved and we want to be active in them. We have a lot of experience in them. We've been doing this. The person that runs our distress team has been doing it since 2004 for Aegon. It was the first person I hired. I've been there since 2006. I've been there since 2004. So we've been together a long time. We want to be involved. We want to be active. Is it getting better? I think so. I think there's playbooks out there that people kind of know the path that they're on. And the reality of it is, the more exposure, the more activity you have in a market, people always get smarter, more efficient, have a better understanding. Lenders are trying to figure out how to get into form co-ops and get more equality amongst groups and have less lender-on-lender violence. There's less market panic because people have seen how they play through. So generally, I think it gets a little bit better in the sense that you just understand the process around it. It's not without its headaches, though. I mean, there can be very time consuming. There can be legal fights. There can be challenges. And, in the big picture, the liability management is just part of a credit cycle now. It's become what we used to do a few years ago, going through restructuring. It's just a different way to do it. And the genesis of this was, as always, looking at companies in situations where they need time or liquidity. That's usually at the core of all this. They need some flexibility of time, some piece of liquidity, and we've seen is a lot of proactivity from lawyers, from financial advisors saying, okay, I look at a company, and so they're saying, okay, I can see it coming. And because of the outcome that's there, the potential of it, they want to be very proactive in going to companies, whether that's with us as lenders or through financial advisors, of being proactive, because maybe it gives you better upside, moving up in structure, getting better collateral, getting better fees, better interest rates, whatever it might be, to try to accomplish that and give the company what they want, which is generally time and liquidity.
Yeah, although as you pointed out, Jim, we're certainly seeing evidence starting to build up now that that time and liquidity granted through LMEs doesn't necessarily lead to a good outcome for the company at the end. So moving on a little bit, given your background, you're clearly better placed than most PMs to deal with credits that are starting to look trouble. I think the thing which is challenging everyone at the moment is how do you decide when to go all in and when do you cut your losses and sell? What's your take?
As I said before, the levered credit market is certainly in challenge situations is incredibly idiosyncratic. It's situation by situation and understanding. We've got a lot of experience across our team, and we're very team-based. We're going to have the primary research person, the distress research person, and our leadership across distressed and myself look at situations to try to figure out where are we in the cap structure, where do we want to be, do we like the business? Because at the end of the day, what we really like to see in these situations is kind of good business, bad balance sheet. That means we like the business that's going through some cyclical trough, something that's impacting them, but is transitory in nature, so we can see a path to recovery. So that's at its core. But every situation is idiosyncratic. Where we're going to go all in is where these all come together, where we like the business, we believe in the landscape in the future, we see a path to recovery, and where we are positioned in the capital structure gives us some level of influence and control, where we can effectuate an outcome. We've done that for all the years I've been here. I've been here 21 years in across the stress. That's always been our approach, and it will continue to be. So it's idiosyncratic, it's unique, but influence, control, and we can effectuate an outcome because we believe in the business is always where we're going to be to go all in, as you said.
But I guess, Jim, and I'm interested to hear your take. What people tell us is that what's changed now is that because LMEs, because the groups form so early and it's difficult to get out of that once the group's already formed, it means that you have to make a decision much earlier than 10 years ago when you had a bit more information on a stress credit.
It's even more so than that. You're 100% right. It's not only making decisions earlier, it's having scale, right? Because co-op agreements have tried to eliminate what had happened in early stages of LMEs, which is the larger creditors, the larger lenders have come in and tried to take control of the process. So if a company's going to go into an LME transaction, and by that means they're going to take control by, putting money in the capital structure, providing liquidity to get, better collateral, better positioning, better fees, more priority in the situation. So when they do that, then that could force the hand of some of the smaller creditors who can't, because they can control the vote, to get voted right out of the situation, find themselves in a second lien or a third lien, and even having forced to take discounts. So it's not only making that decision early in the process, hey, do I want to get around, but do I have the scale to be a part of it? And that's been the biggest issue for us, is trying to figure out, hey, we're the 15th largest lender in this situation. We either got to get bigger because we know it's going through a process, or we got to get out because we're going to find ourselves disenfranchised here. That to me is the biggest challenge of the LME thing. And it's trying to get better because these co-op agreements, you get the scale of the cooperation agreement to say, hey, we're all going to work together. We're all going to be we're not going to allow this sort of hearing of lenders. That's the success story of that. But that's the issue. It is, you have to be early, you have to decide, and you have to decide whether you want to get the scale to, again, back to effectuating the outcome. That's where it gets back to you. Can you be a part of the solution, not just stuck in it? And that's the biggest change that I've seen in these LME transactions where we were before.
Now, I know you can't discuss specific credits, but if you could walk us through one or two anonymous situations that you think are particularly interesting, I think that would be great.
Yeah, sure. I mean, and as I said, a lot of them generally involve a company, the example of a company coming to you and saying, I've got some near-term maturities. And this isn't a situation we're involved in. A company in near-term maturities, and they had liquidity challenges because it was a good business, bad balance sheet. We liked the business. So I will tell you the outcome of this was the company was able to double their liquidity position and extend their maturity out 2 years. What happened through the process was they went to lenders. There was a cooperation agreement established, which was very helpful in the situation. So they went to the lenders and said, hey, this is a situation. This is what we're going to offer you, an incremental collateral to move. If you brought new money, you were able to move up into a higher collateral position, right? You provided the capital, you got the new money, you agreed to extend your maturities. In the midst of that, you remove some covenants and events of default out of the situation. And then effectively, because we had a cooperation agreement, and this is a very generic example, but one that just occurred. We had a cooperation agreement in place. We had 99% support of the lenders to do the deal, even though if they brought money or didn't bring money. Those who brought money were able to kind of move up in priority, and they were fine with that because it extended maturity. It provided incremental liquidity. And if you're even a lender that couldn't provide new money, you're okay because you kicked the can down the road longer. And you gave the company a liquidity path to recovery. That is a very generic, good situation where all lenders came in. They recognized what the company needed, good business, bad balance sheet. They saw what liquidity was. They figured out what they could do from a collateral perspective to give the new money and they took out an existing facility. In the process of that, what the company needed new money to provide the collateral support that they need to give it to liquidity and time, and the other lenders didn't mind going, we'll call it, in a second lien position without taking any discounts because they gave liquidity and time. That is a very generic example of a situation where, and that's it. Unfortunately, you see the other kind of situation where you have tremendous flexibility in structure. You've allowed a company to create, a different basket, a different subsidiary where they can move collateral in. The top, 10 lenders will get 50% control. And this is another example, got 50% control, agreed to provide capital in the situation to move to a different box where they move the collateral. So they move the new money in there, move their old holdings in there, had the vote because the document was structured such that they only needed simple majorities to do this type of structural movement, and basically created second and third liens that forced lenders to either take a discount or stay in a position. You're now, when you were in a facility where you were the first lien before, you're the third lien below $1 billion of loans. So there's an example of a situation where that was more coercive. There wasn't a cooperation agreement in place. A certain number of lenders who created a small majority were able to gave the company liquidity and time, but they got collateral, interest rate, a better interest rate and fees, moved their existing holdings into that pool of collateral and the first lien, had a little bit of a second lien that also didn't any discounts to it, and those who couldn't participate or didn't want to were in a third lien. And that's the more coercive structure where you see a lot of lender-on-lender violence. You might see litigation because of disenfranchisement. That's the kind of stuff that goes on. So those are two examples. One that's, hey, we've got a cooperation agreement in place. Everyone gets it. Good business, bad balance sheet. The second is more coercive, control by larger lenders. And that second one, getting back to your previous question, is where scale matters. If you're sitting down there and you don't have the scale to be in that, that steering committee, that top 10 lender group, you've got a decision to make. Do I stay in the third lien and hope it makes it? And we've seen situations, the one I mentioned is going right back into round two, probably into a bankruptcy, and that third lien that said, nope, I'm going to hold on to my 100% par value in the third lien is probably going to get wiped out. So those are the two dynamics of generic situations you see, but both were real situations that occurred.
And Jim, is there any easy way, when you're looking at this right at the start of the process, to tell if you're going to be in a situation one or if it's going to turn into a situation two? Do you have any tips for people?
I think it's very clear early on that if you see a steering committee organized, informed, that has no interest in a cooperation agreement, and the structure of the document allows simple majority of voting, and there is inflexibility of movement of collateral and assets into different subsidiaries, that's your telltale sign. When if you can figure out a way, I feel like there's more cooperation agreements going on now because I think people are getting more aware earlier on that this could happen and try to organize themselves more broadly as a group. Again, ultimately, you just have to be early in the process, recognize the situation, and really understand the structural the documents and the structural flexibility. And if the holdings are aggregated, I mean, if it's spread across a number of CLOs, you've probably got a better chance of being in a situation where you're going to have a cooperation agreement in place, and because CLOs don't really want to take discounts at par. And then if you find yourself where you've got more hedge funds, you have accumulated holdings, and they can see a path to control and do that, that's what it is. Those are the telltale signs. Are always the documentation flexibility, honestly, and who the holders are really. If you've been honest, it's probably where you think about and go.
Okay, great. So we've discussed the details of some LMEs and the broad market situation, but I guess at the end of the day, what does this mean for the bottom line, for the funds you're managing and the CLOs you manage?
Well, it's pretty impactful. I mean, if you're a CLO manager, having par impact is pretty important to your CLO. So it gets back to what we talked about earlier. We've got to be proactive. We always want to be in places where we can effectuate outcomes. We want to be in a place where we can see a path to recovery, good business, bad balance sheet. But the most important thing we have to do, honestly, is be proactive about underwriting, be out of these situations earlier, be good we're very team-based, we're very research-oriented, we leverage on distress, and we're trying to get out of the situation when the loan is at 95 and it's kind of just before it gets under stress. And see, again, that's the ultimate goal. If we're doing, it, like I said, this is an asymmetrical asset class where defaults and having impact on par is a challenge for the loan market, certainly for CLO managers. So we're trying to be proactive up front, do good credit work, get a great job from any standpoint. If we see trouble, get out before it's, the loan's at 95 and not 65, number one, or the bond. If we get in those situations, we want to be very early on in the process to say we don't have the scale, we can't compete, we can't affect an outcome, we don't like the business, whatever it might be, and exit. It's all about exit early. Maybe you come back into it later. And if we are there, then we're trying to lever our years of experience to try to understand the path to a good recovery and being a part of the solution as best we can. And that's the focus. I mean, it's, as I said, everything is idiosyncratic. Every one of these situations are unique. There are playbooks out there that the financial advisors and attorneys try to follow and creditors try to follow, but every situation is an evaluation of itself. And you just got to rely on your research, your experience, your expertise to know what to do and try to get out of them early, either get out early or understand a path to effectuate a positive outcome for your investors.
Yeah, and we're hearing from a lot of CLO managers that and investors that there's a general shift to being more risk averse and running more conservative portfolios, which is great, but obviously that does lead to hits to cash flows.
Your comment about impacting cash flows is an interesting one because I think you're right. I think, if you're a CLO manager, I think being more conservative in focus is probably a path to try to avoid some of the LME activity and not impact. You'll take a little bit less spread to not have the risk or the impact of par loss or defaults in your portfolio, which are more impactful. Trying to upgrade, certainly we run CLOs that are trying to be a little more conservative, a little more par focused in what we're doing, and that's, I think, it doesn't keep you away from all transactions of challenge or all restructure LME activity, but hopefully you miss more than you get, and you're in when the ones you're in, you can see a path.
Okay, so Jim, given the way the CLO engine is roaring this year and stoking demand for loans, it seems unlikely that lenders will get the upper hand in negotiations anytime soon. But is there anything you think the market should try and push back against in particular?
I think one of the key things I mentioned is, looking at covenants and not giving borrowers the ability to move assets into, unrestricted or non-guarantee subsidiaries. Improving voting rights, or making it not just simple majorities to deal with liens or other types of things. I mean, those are the types of easy things you can do in documentation to ensure that, hey, assets can't be moved out of subsidiaries. There's not a simple majority that can, eliminate and, get rid of things like, move coupons, maturities, principal, covenants, and all these things by simple majority. I mean, if that's the one thing, that I'd say those are the things that you really want to do, because where you've seen the problems is lenders come in, these large lenders come in and say, oh, we'll give you $100 million, but we want those assets and we're going to set up a subsidiary to do it. The documentation offers the flexibility, and we just need a simple majority to execute the entire process of moving maturities or coupons or all that. We can just do this with some majorities, and they don't have to have as much control. So if you can change, making sure the voting rights provide protection, even making unanimous certain things like coupon or maturity, that's going to provide a lot of protections. And again, not the ability to move assets into non-guaranteed subsidiaries is critical. Those are where the problems really exist. They give control away in simple majority ability for companies to put money in, or lenders to put money in and get that type of priority. So that's where I'd start. The problem with it is that, again, there are so many warehouses out there. There's such a technical demand that they're not looking at going through the documentation, because the company go like, okay, well, you say that, but I've got another 50 lenders over here that are going to are fine. So you can just miss this one. And that's the weird discipline and the pushback that needs to happen. But it's got to be collective. It's got to be a collective across, all managers. Otherwise, it just doesn't work. And the market right now is tough because of that demand and that technical bid.
Okay, great. So, Jim, we've got a couple of minutes left, and I want to flip things on the head now for this last section, because you also manage stressed and special sits funds. So, putting on your other hat, how do you see the market from that viewpoint? Is everything we've discussed helping those funds, or is it hindering them?
Well, I think distress managers in general, they like to have opportunities. They like to have the ability to find alpha, find opportunities to create, to get the types of IRRs that required as distress managers. And so, I mean, LME activity and the creativity around it and all that does create opportunities. And we don't really see defaults picking up significantly. That's always the barometer of distressed activity. And triple Cs are not anywhere near all-time tights, but they're kind of in a level of sort of in the middle of the road, kind of where they sit. There is enough default activity. There's enough LME activity to create a lot of options for distressed managers to have things to do. And we see it a lot. We see it, especially in the loan market. There's probably a little more default activity in the loan market or a little more LME activity in the loan market because there's more documentation flexibility and a little more ability to do things there. But than the bond market. But that being said, I do think it's a good environment for distressed investors. I do think there's enough out there. You still have higher underlying rates. So you still got that sort of like getting decent IRRs still exist. But more than anything else, there's enough transaction opportunities out there. And just think about where the market is. And we talked about that at the outset. You still have higher borrowing costs. You still have to figure out the impact of tariffs. You still have the challenge of input cost. The longer it goes, I mean, the leveraged loan market's a floating rate asset class. It weighs on companies. You haven't seen from the first round of LME activity 2 years ago to where we are now. A lot of those companies are coming right back to, and having to do it all over again or go into a formal bankruptcy. So there's a lot of optionality and opportunity out there with all these companies and the future out there. So I do see it as a very interesting time as a distressed investor, an opportunity to find ideas, to find differentiation, and to generate the types of IRRs that are probably pretty compelling in the marketplace. So I tend to like the market. It's not the great financial crisis, it's not COVID, but there are a lot of opportunities out there because the weight of borrowing costs, the weight of higher input costs are on companies.
Great. Well, thanks, Jim. That's all the time we have. Thanks for a really fascinating discussion, and thanks everyone for listening.
Thanks for having me. I appreciate the time.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin